It's data dependent, and given the uncertainty that's there, certainly anything could happen, but I think it's highly unlikely. There's very little wage pressure that we're seeing in the U.S. We're seeing very little inflation pressure, and inflation expectations have been moving down rather than moving up. And given the uncertainty that I don't think is going to be resolved anytime soon with respect to the United Kingdom and Europe, I don't really see it likely that the Fed is going to move, probably not before the fall, and probably most likely not until next year.
Wow, how much is the bond market holding the Fed back, you think? Or rather, how much of an eye do you think the Fed is keeping on the bond market? Because, I mean, you've got that yield curve flattening, drifting even further south. You've got the 10-year hitting record lows. And, when stuff like that happens, it hasn't quite gone inverted yet, but when stuff like that happens, it signals recession. Are you in that camp thinking that we're about to tip into recession?
I don't think the evidence is there yet. I mean, certainly we had a weaker employment report than we'd had earlier, but I think we have to step down the number of jobs we're creating each month. We've been creating 200 to 250,000 jobs a month. That was great for a few years, but it's not going to be possible for the U.S. economy to continue to do that now that the unemployment rate is below 5%. I don't really see other signs in the economy of recession. And I think largely what's happening is the reason that the 10-year has come down so much is not because of domestic problems in the U.S., but because of problems abroad. Everyone's running to the U.S. just like they're running to Japan, running to Switzerland, because they want safe havens given the uncertainty of what's going on in the U.K. and Europe.
Okay, so it's mostly basically safety money exiting the mess in Europe and also the ongoing problems in Japan. I hear you there. But, this sort of setup and this sort of situation, because rates are so low and going ever more negative in other places, ex-U.S., it's got a lot of people thinking, look, after 10 years of this kind of stuff, unconventional stuff by central banks, it's time for governments, and I don't care whether they're up to the eyeballs in debt, et cetera, to do something on the fiscal side. And this low or negative yield situation is the perfect opportunity for them to borrow at cheap rates, long, and invest in stuff like infrastructure, et cetera, get the private sector involved, get productivity up, and help the global economy. Does that make sense to you?
I think one of the last points you made is really the key as far as I'm concerned, getting productivity up. I think that is absolutely crucial, and we have not been focusing on that. We've not been focusing on pro-growth policies, and that's what is ultimately needed to get the economy going. And so thinking about tax policy, I mean, we have corporate tax policy in the U.S. that really doesn't make any sense, terrible incentives for investment, and we give strong incentives to keep funds abroad rather than bring it back home. That makes no sense. George Osborne in the UK has come out with suggesting that maybe what the UK needs to do is to cut corporate tax rates to maintain its internationally competitive position, given that it may be losing some other aspects of international competition by exiting from Europe. So I think focusing on the structural policies, the pro-growth policies, the productivity policies are really the key. It's not just spending for spending's sake. If there's a good project that has a lot of benefits for breaking down a bottleneck and making the economy more productive, that's great. But just spending for spending's sake, I don't think really helps.